next guest saying that the Fed's narrative will shift from quote-unquote progress on inflation to risk management for growth. We want to bring in Ben Mandel. He's at GBRT Capital's head of research. Ben, it's great to have you here. So as you take a look at this very strong labor print, we've got traders right now shifting the full pricing here of the next Fed rate cut all the way out until October. What's your big takeaway?
I think the big takeaway is that it's extremely important to contextualize these data points in the broader context of the U.S. business cycle and what that's telling us about risks to growth and inflation. And the predominant factor here in this cycle is the avoidance of recession. And so there's an exceptionalism in the soft landing in itself. It's unusual in historical context, and it also creates a dynamic for growth and inflation that's highly atypical. So over the last 2 years, we've seen both growth and inflation decelerate, but decelerate very slowly, which is it's a strange phenomenon at the end of the cycle. And so what does that mean? The upshot for the economy and markets is that the short-run momentum in growth and inflation is really driving it's driving everything. And we saw that over the course of the last year. Q1 of 2024, momentum rose, and the Fed cuts came out of the outlook, markets reacted, and then mid-year, momentum waned, it went down, all in the context of growth, which is chugging along at a steady pace. And so it's really short-run momentum, which is really the key determinant here. And you can see that today's jobs report is indicative of high momentum in growth. I would kind of take the opposite side of the argument and say we've kind of reached a peak, a local peak in both growth and inflation. We're kind of where we were in March, April of last year when everyone was extrapolating out, the Fed is done, they might start hiking. We've reached those levels of pricing. And I think the next step, to be honest, it just is a natural oscillation back downward over the next few months or quarters in both growth and inflation. And as such, as you said, the narrative is going to shift. It's going to be less concern about inflation, more concern about mitigating risk associated with growth.
What happens during a natural oscillation that you're talking about here? Because that would signal, at least for a Fed that's so data dependent and not seeing data that's strong enough to go one direction or another, that they could just be sitting on their hands for a while, but also the market anticipating that they could take other balance sheet measures, that there still would be the tone that would rattle through investors' mindsets and trying to figure out, okay, even if they are pushing out a move, then in the near term, what moves should investors be making as well?
Yeah, I think part and parcel of short-term momentum being very important is that monetary policy is going to absorb some of that volatility in the short-run data. And so I think what we've seen in terms of Fed pricing going from, over the course of the last 12 months, one rate cut or 6 rate cuts to 1 rate cut, back to 3, now back to 1, I guess, or fewer, is indicative of the Fed being data dependent and by construction absorbing some of the volatility in the underlying data series. I think the key thing to note is that we have to accompany the momentum in the short run data flow, which despite today's jobs report is not unambiguously strong. So that's one thing. And then as we consider the massive changes in policy that are in train and the raft of new policies, we have to think, well, are these more likely to affect growth or inflation? And I think the answer is almost unambiguously, and this is not a consensus view by any means, but it's almost unambiguously growth. So as we think about the extensions of the tax cuts put in place in 2017, most of those have to do with extending existing individual tax cuts, not introducing new tax cuts into the system. And so it's about maintaining the status quo, not necessarily adding new stimulus. If we think about tariffs and immigration, and I think there's a wider range of views on this, but I think the negative effects of growth of those policies will outweigh the positive or upside risks to inflation. Those are growth shocks, not inflation shocks. And so at the end of the day, I think when going back to your question about how do policymakers see these things, they'll obviously wait to see how the data play out. There's a natural volatility associated with Fed pricing as a result. But at the end of the day, we're wagering that it's mostly growth shocks and fewer inflation shocks, and therefore, your directional view on treasuries is going to depend on whether you think growth momentum is rising or falling. I think we're comfortable owning durations at these levels in view of the fact that we think the dynamic in growth momentum is going to turn.
But what does all this then mean for investors? They're trying to figure out exactly what the gains could potentially look like this year if we don't get any more rate cuts, or if rate cuts are essentially pushed out to at least the second half of the year. Is that going to maybe take off some of this momentum that we have seen from the recent rally?
That's a good question. I think momentum is certainly important. I would say the thing where maybe investors have where they've erred is in putting a little bit too much weight on valuation as a signal. And so, when we think about, I think the key example of that is the U.S. versus the rest of the world. You could have argued any time pretty much over the last 10 or 15 years that the S&P is expensive. Part of that is probably coming from the fact that we have very little, perhaps we're underestimating the importance of the S&P containing important global firms in important global industries. And as a result, perhaps maybe underestimating the fair value multiples associated with those, and then overestimating how expensive the U.S. index was relative to everyone else. And so, I think momentum is important. I would say valuation is probably less important than investors have been wagering over the last, few years.
Interesting. Ben, thanks so much for taking the time here with us after the December jobs report and ahead of the opening bell this morning. Appreciate it.
Thank you very much.
Certainly.